Alright, hi guys. So in this video, or part 1 of this video, I'll be covering the 10 golden rules of winning traders as promised. I know a lot of you watch my golden rules of investing, and I said I'm gonna do one on trading, so here it is. Now, for those of you who watch my investing rules, my golden rules of investing, do know that for trading, the rules are totally different. In fact, sometimes even contradictory. Because investing and trading are two totally different games. It's kind of like basketball and golf, two totally different games. I mean, they both involve balls, but they've got totally different rules. In one game, you can use your hands to touch the ball. In the other game, you touch the ball, you get a penalty stroke. You got to hit the ball with a club. So two totally different games. So similarly for investing and trading, they both have very different rules. In investing, if you buy a stock of a business and the price drops, the right thing to do is to buy more at a lower price, to average down. Whereas for trading, you never average down. In trading, you buy a stop, you got to put a stop loss. The moment the price drops by say 5% or 1 ATR or 2 ATR, you got to cut your loss, you got to get out. So why totally different rules? Because in investing, we only focus on buying very good businesses with durable competitive advantages. We only focus on the top 1% of businesses in the world. And these are great companies that will keep increasing in value. So when the price drops, you're getting to buy a great business at a better price. You want to buy more and more and more. Whereas for trading, it's different. In trading, we don't buy only great companies. We trade all kinds of companies. We trade cryptocurrencies, we trade forex, we trade commodities and futures. We are focusing not so much on any business that makes money. We are focusing on a ticker symbol that has price movement, and we are kind of like anticipating where the price is going to move, right? So the moment the price doesn't move in our direction, we got to cut our losses, because things like, cryptos or lousy companies, they can go to zero. So you got to get out. Very different concept. I've used this analogy before. Investing is like getting married, and trading is like a one-night stand. So in getting married, we only want to marry certain kinds of people with good character, good fundamentals, and they are very hard to find. Same thing. In the whole market, I keep telling people that only 1% of stocks out there are investable. These are the fundamentally good businesses that are very rare, and these are the ones that you want to marry. But then again, in a one-night stand, you don't really care about the person's character or values, right? As long as the person is hot, you just go for it. But it's more risky, and that's why in trading, you gotta have a stop loss. In a one-night stand, you gotta have protection. Also remember that stocks and assets that we use for trading are very different from assets or stocks we use for investing. It's kind of like there are some people who may be very good for dating. They make very good girlfriends and boyfriends because they are very sexy, they are very hot, they're very exciting, but you never want to marry them because they are not responsible, they are not dependable, so you never want to marry these people. So you got to understand same thing in the markets. You got to understand what are the stocks only for trading and what are the stocks only for investing. So once again, in this video, we're going to focus on stocks and assets just for trading for the short term. So these are the 10 golden rules of winning traders. So golden rule number 1, before you even start trading, you have to start with a well-defined and written trading plan. So what should be inside your trading plan? You should write down all the different trading strategies that you're using. Now, you could just use one trading strategy, or you could have several trading strategies, but I would say not too many. I think 2 or 3 strategies would be optimal. What would be useful is to learn strategies for different phases of the market. So for example, when the market's on a clear uptrend, you can use a pullback strategy. One of mine is called the trend retracement strategy, or you can use a breakout strategy. If the market's going sideways in a consolidation, you can use a mean reversion strategy. And the one that I use is called the slingshot mean reversion strategy. If the market's on a downtrend, like a bear market now, then you can use a rally on a downtrend strategy or a breakdown strategy. So again, it's useful to have different strategies that you can pull out when the market goes through different phases. So whatever strategies that you use, that you choose to use, it's important that they must have a statistical edge in the markets. And they must give you a positive profit expectancy. So what does that mean? Remember that whatever strategy that you use, you can't have winning trades all the time. You're going to have winning trades, you're going to have losing trades. But you got to ensure that whatever strategy you use, your wins far exceed your losses. So that results in a net profit in your trading by the end of the month or end of the year. That gives you a positive profit expectancy. Now, in Rule 2, I'll talk more about how to ensure your strategy is a profitable strategy. So whatever strategy you use, you have to write down specifically 3 things: your entry rules, your exit rules, and your position sizing rules. And again, I'll give you lots of examples in the next slide. So your entry and exit rules can be based on both technical and or fundamental criteria. And your position sizing rules basically tell you what's the percentage risk per trade and the number of open positions that you allow yourself to have in your account. In other words, your money management rules. So unless you clearly define these 3 things, entry rules, exit rules, and position sizing rules, it is not a proper strategy. All right, next. A lot of people ask me, Adam, what's the best strategy to use? Because there are thousands of strategies out there. Now, here's the thing. There's no one holy grail strategy. There's no the strategy. There are many, many strategies. So, for example, if you take a look at successful traders, you find that they all use very different strategies. Like, for example, some traders, they like to use a trend following strategy where they trade with the trend. When the market's on an uptrend, they go long. Market's on a downtrend, they go short. So that's what we call a trend following strategy. And again, within the trend following strategy, there are also 2 types, or there are more than 2 types. One is a pullback strategy, right? Where you see an uptrend, for example, you wait for the price to pull back or to retrace to an area of support, for example, like a moving average or like a Fibonacci level, and you buy here, right? You buy here to catch the next wave up. So that's a pullback or retracement strategy. Then there are some people who like to use a breakout strategy where they wait for the market to go up and they wait for it to kind of like go into a base like that, like a cup of handle, and they wait for it to break out of this previous resistance. And this is more of a breakout strategy. So again, very different, correct? And there are some people or some traders, they use a counter trend strategy, which means they don't trade with the trend, they trade against the trend. When the market's on an uptrend, they look to short the market when it's overbought. For example, it goes up and they sell to capture the reversal. This is also called reversal trading. And similarly, if the market's on a downtrend, they wait for it to be oversold and they buy to catch the reversal. So we call this counter trend or mean reversion trading. So again, very different styles. And again, there are some traders where they focus on using indicators, whether is it using MACD or stochastics or RSI or Ichimoku or Ichi backside or whatever indicator they want to use, or Fibonacci or Elliott wave or whatever it is. Actually, Elliott wave is not really an indicator, so sorry about that, right? But then there are some traders who like purely price action with 0 indicators. And people like to ask me, so what's the right way? What's the best way? Well, again, there's no the right way. There's no the best way. I've learned all the different strategies, and I can tell you this, they all have their pros and cons. Every strategy that you use works well in certain periods and doesn't work well in other periods. For example, if you follow a trend following strategy, this kind of strategy is very profitable when the market is trending nicely. But when the market goes sideways, that strategy has a lot of losing trades. You go through a losing streak. Similarly, if you use a mean reversion strategy, that produces a winning streak when the market is consolidating. But it creates a lot of losing trades when the market is trending in one direction. So again, every strategy that you use will have good periods and will have bad periods. So the key to being a profitable trader is not the strategy itself, but the holy grail. The holy grail in trading is to be consistent, is to consistently stick to one strategy or two or three strategies so that you go through both the winning streaks and the losing streaks. But the wins will more than cover the losses if you stick to your entry rules, your exit rules, and your position sizing rules. Before we move on to the next part of this video, I've got exciting news and announcement. I'll be conducting a free live online event for all my viewers really soon, where I'll go into detail on how I identify and analyze the best stocks in the market that will survive this uncertainty and help you to profit from the rebound. I'll also teach you how to develop the psychology of a winning investor and show you my ultimate investor's watch list of stocks that's going to lead the next bull market. So registration is opening really soon. Seats are very limited. Click on the link in the description right now to be placed on our event priority list, and my team will send you an email invite really soon. So I look forward to seeing you at the event. Now on to the rest of the video. So once again, the holy grail is not in a particular strategy, but it's about being consistent with your chosen strategy, and that leads to long-term profitability. So here's an example of a trading strategy within my trading plan, and this is a trend retracement strategy, which is based on a trend continuation or trend following approach. So what are my entry rules? So my entry rules before I enter a trade going long, number one, I want to ensure that the overall index is on an uptrend. That's the first thing. Because when the whole market's on a downtrend, then you go long on a specific stock, the chance of that stock going against the market is lower. So you want a market to be on an overall uptrend. Second, the stock itself must be on a confirmed uptrend. In this case, let's look at APTS. And so you got to be specific. What do you mean by uptrend? So to me, I define uptrend as the 20 EMA must be above the 40 EMA, which is this red dotted line above the blue dotted line, the 50 moving average above the 150 moving average, the blue line above the green line, and the price above the 200 moving average, which is the red line. So when all these moving averages are in sequence and sloping up, that tells you that it's a clear uptrend. So on a clear uptrend, you want to trade with the trend. You want to go long, but you want to enter during a pullback, during a retracement. So we wait for the price to retrace to an area of support. And usually, I want to ensure that I've got a double support. What do I mean by a double support? So in this case, you can look at this price action. Price waves up and then pulls back to this level of support. So first, it hits the 50 moving average, which is this blue line. And I want to ensure that this 50 moving average has been previously tested to be a strong support. You can see it's been tested before, it's been tested before, it's been tested before. So this is a tested support level on the 50 moving average. At the same time, it is also at a horizontal support level, right? You can see previous resistance becomes support. So we have a double support level on a moving average and on a horizontal support resistance level. So I know that this level is a level where we could have potential reversal in the pullback. But I've got to wait for a bullish candlestick pattern, right? So I want to see a kind of a bullish pattern forming. And at the same time, after this retracement, I want to make sure that the stock is oversold. So I use an oscillator. You can use RSI, you can use stochastics, it's all the same thing. But in this case, I'm using the Williams percentage R. So I want to ensure the Williams R is oversold at the point of support over there, right? So I know the price is at a support, it is oversold, I've got a bullish candle, so there's a chance the price is going to go up. So what do? I have to put my buy entry. In this case, my entry rules is a buy entry 2 to 10 cents above the candle pattern, depending on the price of the stock. So in this case, the stock's about a $13 stock. I'll just put it about 3 cents above the high. So my entry price, as you can see, is at $13.53. So the next day, if the price exceeds the high of my bullish candle, it would trigger an entry into this trade. Now, because it's a trade, we gotta have a stop loss, okay? So you gotta have your exit rules. You either exit at a loss or you exit at a profit. So you gotta know where to put a stop loss. And again, different strategies place their stop losses differently. It's all about being consistent. So for me, I like to put my stop loss right here at $12.55, which is 1 ATR, which is average true range, 1 ATR below the level of support. So I've got enough buffer for the price to move and not hit my stop loss. So I'm buying at 13.53. My stop loss is at 12.55. So what's my stop loss distance, or my 1R? R means the risk per share. So you can see in this case, my risk per share is 98 cents. 13.53 minus 12.55 gives me 98 cents, which is my 1R distance. Now, where do I take profit? So again, in trading, ideally, if you're risking $1, you want to make more than $1. So you could risk $1 to make $1.40, $1.50, $2, $3, up to you. Be consistent. So for this strategy, I want to risk $1 to make $2. So if my stop loss distance is at 98 cents, then my profit distance should be double of that, which is 196. So 196 above my entry price of 13.53 gives me a target price of 15.49. So that's how I set my profit at 2R above the entry price. My strategy also includes position sizing rules. How do I size my position? So in this case, I only risk 1% of my capital. And in the next couple of rules, I'm going to show you how to calculate the number of shares in order to only risk 1% of your capital. So this is an example of a trade. So in this particular trade, it was a winning trade. The price went up the next day above the high of this candle. It triggered my order, and it took about a week to hit the profit target. Now again, will you always have a winning trade? No. I can tell you that half the time you're going to have a winning trade, and half the time is going to be a losing trade. But if you consistently follow these rules, where you only buy on a clear uptrend, you buy when there's a support level, double support, you buy when there's a bullish candlestick pattern, you buy when the odds are in your favor, and you take profit, so your profit is more than your loss, then it will result in you winning more when you're right and losing less when you're wrong, leading to a net profit over a large sample of trades. Golden rule number 2 is to ensure that the strategy you're using is statistically profitable. So how would you know? Well, you got to do some math. All winning traders, they use this formula, and the formula goes this way. Your expected profit per trade should be positive. This is your percentage win multiplied by your average win minus your percentage loss multiplied by your average loss. So let me give you an example. So let's imagine that you have a capital of $10,000 in your trading account, and you decide to risk 1% of your capital on any single trade. Now later I'll show you how to calculate the number of shares to trade in order to risk 1%, but we'll do that later. For now, just stay with me. All right. So if you risk 1% of 10 grand, that means that if it's a losing trade, what's your average loss? Your average loss is $100, right? 1% times 10,000 is $100. Now, what's your average win? Well, it depends on where you put your profit target. If you put your profit target double distance from your stop loss distance, your average win would be $200, for example. Okay. So if you risk $1 to make $2, would you have a profitable strategy? Yes. So let's assume that you use a trend following strategy and your win rate is, say, 50%. So if you got a 50% win rate, will you have a profitable strategy? Well, let's put it into this formula. Equals to your win percentage. So let's say we give that a 50% win percentage multiplied by your average win. In this case, is $200 because your profit target is double your stop loss distance. And then we minus your loss percentage, which is 50%. times your average loss, which in this case is $100. Okay, so let's do the math. 50% times 200, that's 100, minus 50% times 100, that's $50. And that gives you $50. All right, so what does that mean? That means that, when you have a losing trade, you lose $100. When you got a winning trade, you win $200, right? And if you keep doing this again and again and again, half the time you win, half the time you lose, on average, each trade will net you $50 in net profit. So if you do, for example, 100 trades in a year, that will be $5,000 of profit in a year, for example. So this is an example of a statistically profitable trading strategy. Now, can we control our win rate all the time? No, there'll be times when our win rate may go up. When the market's trending strongly, our win rate may even go up to 60-70% during a winning streak. But there are times when the market gets very choppy and we may lose more than we win, where our win rate may drop to only 40%. But even at a 40% win rate, will you be profitable over the long run? Yes, provided your risk to reward ratio is risking 100 to make more than 100, right? So let's check this out. So let's say, for example, your win rate drops to only 40% because the market's choppy. So 40% win rate multiplied by your average win, which is $200, minus your losing rate, which is 60% losing rate, multiplied by $100 average loss. So if you work this out, 40% times 200, that gives you $80. And 60% times 100 gives you $60. 80 minus 60 gives you $20 profit per trade. Which means that, hey, even at a 40% win rate, you are still profitable. Now, a common question I get is, Adam, why do you target an average win of 2R or $200 for every $100 of risk? Why don't you target a higher profit target like 3R or 4R? Well, there's always a trade-off. You find that when your profit target is too high or you go for too high profits, your win rate will drop even more. So sure, you can target an average win of 300 or 400, but your win rate will not be 50%. Your win rate will drop to maybe 40% or 35%. There's always a trade-off. Now, at the same time, if you target a smaller win rate, instead of going for 2R, you go for 1.4R, for example, 1.5R, where your average win is $150, and it's easier to hit that profit target, then your win rate will go up as well, from 50% to maybe 60%. So in other words, there's always a trade-off. Whenever you increase your win rate, your reward to risk falls down. Whenever you increase your reward to risk, your win rate goes down. So there's always a balance between the two. Now, some people ask me, Adam, are there strategies where I could get a very high win rate, like a 70% or 90% win rate? The answer is yes. In fact, when I trade options, I use credit spreads. And for my credit spread strategy, my win rate is on average 70% or even 90%. But there's a catch. There's a catch. When you have a strategy with a high win rate, then you don't risk $1 to make $2 anymore. In fact, sometimes you have to risk $2 to make $1. So there's always a trade-off. For example, one of the strategies that I use is called the bull put spread strategy, and that has an average win rate of 70%. So 70% of my trades are winners and 30% are losers. But what's the catch? The catch is that for this strategy, when I win $100. But when I lose $150. In other words, I lose more than I win per trade. But is it still a profitable strategy? Yes, it is, right? So in fact, if you do the math, you can see what's my expected profit for this strategy. My expected profit, my win percentage is 70%, times my average win is $100, minus my losing percentage 30%, times my average loss of 150. So if you work this out, this is $70 minus 30% times 150, that's $45. So if you deduct this, you get $25 profit per trade, which is still very profitable. Now, I've got another strategy called the Bull Put Spread Extreme, which has a 90% win rate. But again, for that one, there's another trade-off, which means I have to risk more to make less profits on a winning trade. So the point is this, don't just look at your win rate. Just because a strategy has only a 50% win rate doesn't mean it's not a profitable strategy. It can still be very profitable as long as your average win is more than your average loss. And at the same time, if you want a very high win rate, yes, you can, but you have to risk more to win less on a per trade basis. And there's no right or wrong as long as your expected profit is positive, that you win more than you lose over a sample of trades. Once you have a trading plan and you know your trading strategy is profitable, then rule number 3 is the simplest but the most difficult for people to follow, which is follow the rules, is to be consistent in following your trading plan. And the first thing to do is to be disciplined on your trade entries. In other words, only enter a trade, whether it's a buy or sell trade, when all the predefined entry rules of your trading strategy are met. For example, in that first strategy that I showed you, I only enter the trade when it's a clear uptrend, stochastics are oversold, high relative strength, I've got a bullish candlestick pattern, I've got a double support level, all the stars are aligned, and I enter a trade. Now, easier said than done. I can tell you that most traders fail because number 1, they don't have a trading plan. They don't have clear entry rules. And even if they do, most traders fail because they don't follow their rules. And they enter trades not based on their entry rules, but they enter trades based on the predictions of other people, on reading news headlines or listening to the opinions of other people. And that's how traders get into trouble. Like they hear people say on TV, hey, Bitcoin's going to go up, or gold's going to go up, or commodities are on a bull run, it's going to go up, and they buy and they die, right? So you have to follow your rules, because if you don't follow your rules, you do not have any kind of consistency. And again, never listen to the opinions of other people, even yourself. Like for me, I have the opinion that the second half of the year will be very bullish. But does that mean that I will buy stocks right now as a trade? No, because until I see a clear uptrend, I'm not going to go long. In fact, while it's still on a downtrend, I will go short until I see a confirmation of my entry rules. So remember, follow your entry rules and you have consistent results. But if you enter trades based on external factors, you get very inconsistent results, and in the long run, you will not be profitable in your trading. So I'll see you guys in part 2 of this video, where we'll cover the next 7 rules of winning traders.